Hello everyone, welcome to BTSS Commerce Academy. I am Sudhakar Visapagari and this is my first video where we break down tough accounting concepts into simple exam ready explanations. Today's topic is accounting for provision for expenses, a key adjustment in real world and exam scenarios. Let's get started and don't forget to like, share and subscribe to support this channel. So what is provision for expenses and why is it important? In accounting, we follow the accrual concept, which means expenses should be recorded in the same period in which they are incurred, not when they are actually paid. So, but what happens when we know an expense has happened or will definitely happen soon, but we haven't received the invoice or the amount isn't final yet? That's where provision for expenses comes in. A provision is a liability of uncertain timing or amount. It helps us follow the matching principle and give a true and fair view of our financials. Don't worry about these difficult words. So in simple terms, a provision for expense is money we set aside in the books for known upcoming expenses even though the actual payment hasn't happened yet. So why is it important? It is required to match income and expenses in the same period or the same month and to ensure accurate profit calculation. Then only it will reflect the true liabilities as on balance sheet date or as on the month end. Also, it is required under accounting standards like AS 29 in India and IAS 37. Now, let's understand more clearly with a real life example. Scenario, let's say audit fees of 6 lakhs is expected for current year, let's financial year 25-26. Auditor name is Balaji and Co. Work period April 25 to March 26, and the invoice is not yet received. So the monthly provision entry will be debit audit fee account for 50,000. That 50,000 is like 6 lakh divided by 12 months. That amount will divide it equally. Credit provision for audit fees account, same 50,000. So this audit fees account is created under expenses and the provision for audit fee account is created under current liabilities. Just saying if any one of you doesn't know this. Same entry is passed every month for 12 months and after 12 months the total provision accumulated will be 6 lakhs. Few important points. Few companies follow alternative approach like reversal method where the entire provision accumulated provision is reversed at the beginning of the next year or the next month, and the audit bill is then recorded as a normal expense whenever that bill is received. Overall, the net impact on profit and liability remains the same either way. Also, don't over provide. Estimate based on available evidence. Unnecessary provision can mislead users. Tax implications. In India, most of the expenses TDS need to be deducted on provision basis, and GST anyway it's not applicable on provisions. Document your assumptions. Auditor may ask why a certain amount was provided. Review provisions monthly. Adjust or reverse if no longer needed. Only create a provision if there is a present obligation as a result of past event. It should be probable and reasonably estimatable. Remember, not every estimated future cost is a provision. These are the major list of expenses where we make provision for, like audit fees, taxes, bonus, gratuity, leave encashment, legal expenses, warranties, bad and doubtful debts, sales returns, utility bills, etc. You can pause and read it. So that's it for this video. I hope this session helped you understand provision for expenses, like what it means, why it matters, and how to account for it. If you like this video, please support me by hitting like and dropping a comment and subscribing to BTSS Commerce Academy for more. Let me know what other accounting or CA topics you would like me to cover next. Thanks you for watching. See you in the next video.